Hey Dave, because you missed class, we thought it would be a good idea to catch up on some of the concepts we've done. Let's start with the format changes. Because we have an accumulated loss, we need to add a profit not available for distribution column, which we'll explain more later. We also have ordinary shares and preference shares, which means we need to have two separate analyses for each share type. Let's start at the top with the at acquisition section under the ordinary share analysis. We'll have share capital as normal. Here's the values from our question. Then retained earnings will be a little different. Because we have an accumulated loss, we'll deduct this value. We also need to account for the preference share dividend in arrears. Let's take a look at the calculation. To work out our profit attributed to preference shares, we'll take the total amount of preference shares, in this case 20,000 shares, and times it by the value of the dividend per share. And here you can see our 2,000 Rand. Moving on to the revaluation. Because Work Limited valued equipment at 60,000 Rand compared to Uni Limited's 50,000 Rand, we have a re-evaluation surplus. Let's take a look at that calculation. We need to work out the after-tax amount by taking the 10,000 Rand surplus and deducting the 28% for tax, which gives us 7,200 Rand, as you can see here. We then put that into our analysis under revaluation surplus. Finally, we wrap up the acquisition section as normal by adding our values to get the fair value of net assets. We put in our consideration and non-controlling interest as given, and our goodwill or gain on bargain purchase will be our balancing figure.
Okay, so next we're going to move on to explaining the changes within the since acquisition to the beginning of the current year and the current year sections. So starting with the since acquisition of the current year, to work out our retained earnings, we have a few changes in there. We've got our attributable to preference shares. As these shareholders will have preference to any other shareholders, we need to deduct it now from our retained earnings. After that, you have to deduct your depreciation after tax from acquisition to the beginning of the current year for the portion of the revaluation surplus. The other change in here is your transfer to profit not available for distribution. We have to deduct this from our retainable funds, as this is to make up for our accumulated loss. We move that into the profit not available for distribution. Okay, so now we move on to explaining the current year section. We need to get to the calculation of doing the profit after tax. We need to take the given profit for this year, and then we need to deduct the depreciation after tax, which is for that section of the revaluation. After that, we also need to now deduct the attributable to preference shares, where they will get their preference on this profit section, and then you'll get your profit after tax.
So going on to preference shares, really same, works on the same basis as the ordinary shares. So instead of at acquisitions, the 10% preference shares, that's exactly the same as the share capital brought above. Then, and we just split them in the mentioned in the question, then in preference, dividend shares and the rest, it's going to be exactly the same as Johan explained at the at acquisition, or actually tied it. So we just mention it there. So the only difference is we're not mentioning retained earnings now. We're just going to split them to 30% for us, 70% to the other people. Future value of net assets, real easy, just add them up. Goodwill, just as I mentioned in above, it works exactly the same as ordinary shares. Moving on to since acquisition at the beginning of the current year. So as Johan explained, the profit attributable of preference shares, it's going to be those one, exactly as I said over there. We're just going to split them. So this is was for 2 years now. So the 4,000 gets split 30% for us, 70% for the non-controlling interest. Exactly the same for current year as well. It's just for this financial year as well. Here we can actually relate and see. There we took our 2,000 to split. We brought it in here and we split it 30% for us, 70% for them. And just account everything and get all the fair values, non-controlling interest like I said, since, and the total. Back up.